Hi guys, and welcome to another week ahead video. Now in this week's video our focus will turn to the US dollar. We've seen some very interesting moves in the US dollar over the last couple of sessions, and we think this week's events can create some tradable volatility in the dollar. We have the NFP numbers coming up, of course. We also have furthermore virus headlines. We also have US and China trade tensions starting to heat back up. And we have some very interesting decisions coming from the German Constitutional Court this week that we need to pay attention to for the euro, as that can also affect the dollar in this upcoming week. So join me now to the video to see exactly how we are preparing for these events and how we can trade them in this upcoming week as well. Then looking at the baseline for the US dollar, we have seen quite a lot of support for the US dollar in the first quarter of the year as the world went through that very rough economic patch. Obviously, due to its safe haven status, the dollar enjoyed a lot of support. We can see from this chart from Bloomberg that this is comparing the dollar index to the Fed's trade weighted nominal dollar index. And we can see that huge spike to the upside in that first quarter, obviously due to a safe haven, and the dollar gained ground against most of the G10 currencies, except of course for the more traditional safe havens like the Japanese yen and the Swiss franc. However, after that peak in March, the dollar did struggle to gain more ground, as a lot of the support that we would expect for the dollar during times like this has been largely mitigated by the recent Fed policy measures. In the last couple of weeks, we saw the Fed announce an unlimited QE program alongside additional 9 emergency lending programs to basically increase liquidity. And the US government, of course, has also pledged that US 2.6 trillion to support the economy. Now, apart from that, we've also seen many other central banks and governments to commit to massive amounts of fiscal and monetary stimulus. Now, all of that combined with good news about easing of lockdown restrictions around the globe has seen an impressive recovery in global equities, which has reduced demand for the US dollar. However, there are still a couple of reasons to expect the dollar demand to perk back up. Looking at the data, firstly, recent economic data has just been horrendously bad. Taking some examples like the 30 million jobless claims we've already had in the last 6 weeks, as well as the negative 4.8% Q1 GDP print. Now, sadly, it's important to remember that this is just the beginning of the bad data, as most analysts agree that the real scary numbers are only coming in the second quarter of this year. Also important to remember that recessions don't only last for a few short weeks. They usually last for a couple of months. As the economic gravity starts to set in, we will see demand perk back up for the US dollar in the few weeks ahead. Now, even though unlimited QE should theoretically push the dollar lower, we should also remember that many other central banks is also engaged in lots of financial oppression right now. And all of that is basically just for the same goal as the Fed. They're trying to devalue their currency. So with everybody trying to devalue their currencies, a lot of that unlimited QE should be mitigated in terms of its effect on the US dollar. Now, in the past week, the dollar did come under intense pressure, especially on Thursday due to month-end rebalancing. And traders were a little bit surprised on Friday as dollar weakness continued into the new month on the 1st of May on Friday, despite a very strong negative risk sentiment. Now, a probable explanation for this weakness, it could have been thinner liquidity based on the European and Asia-Pac markets that were closed, but Bloomberg did provide a more plausible explanation in an article recently, saying that the euro demand actually surged sky high as traders not only rushed out of dollars due to month-end rebalancing, but also into euros as part of rebalancing their portfolios, which obviously exacerbated the move into the Friday session as well. Now, looking at the upcoming week, there's a couple of factors that can spark a softer risk tone, a softer risk environment that could potentially see some support for the US dollar. The first one we need to look at is US-China tensions. Now, risk assets traded more cautiously on Friday as President Trump threatened possible tariffs on China, as he explained that he has seen evidence, remarkable evidence, that the coronavirus originated at the Wuhan Institute of Virology in China. Now, President Trump also explained that he is exploring the possibility to block the US TSP or Thrift Savings Plan to invest US $50 billion in Chinese equities. And he also mentioned other possible punitive measures against China, which could be implemented as well. Now, any further developments in this matter will be a very, very important topic for risk assets this week ahead. Also looking to Germany, an event that hasn't really received a lot of attention, which is surprising, is the upcoming German Constitutional Court will basically deliver their ruling on Tuesday about whether the most recent ECB QE program is compatible with Germany's laws. Now, Italian debt markets have really felt pain recently as the EU nations fail to agree on any suitable relief fund to combat the economic slowdown caused by the virus. And this chart below shows the BTP Bund spread at elevated levels once again, which is a real negative input for the euro. Now, if we see the German court rule against the ECB's bond buying aspirations, it could spark further market turmoil and weigh on the euro and, of course, support the dollar in the week ahead. Then turning to data, we have the US jobs report now. There are a couple of interesting US economic data points this week, not only NFP, we have ADP, we have ISM, but the NFP will be the most important one on the schedule for this week. Now, a lot of negativity has already been priced in for this week's NFP with the last couple of jobless claims reports we've seen, which basically suggests that the US lost well over 20 million jobs in the last month alone, and obviously over 30 in the last 6 weeks. However, forecasted distribution shows that the risk is firmly skewed to the downside for this event and could spark some risk off flows. Now, at the time of writing, Reuters placed the consensus for NFP at 21 million, which is the most going back to the Great Depression back in 1939, and expectations are for the unemployment rate to jump to 16%, which basically closely resembles World War II numbers or post-World War II numbers. Now, another thing to watch this week will be earnings. This week saw risk assets taking a little bit of a beating at the close of the week as earnings and guidance from Amazon and Apple disappointed markets. Now, even though Amazon's Q1 earnings were better than expected, the company warned that they might see a Q2 loss, which is obviously a very negative point for markets. And Apple, even though they made a decent profit in Q1, they failed to provide a forecast for the rest of 2020. Now, this isn't something weird because we saw most companies basically choose not to provide forward guidance, but it is very specific or specifically interesting for Apple because that is something that the company hasn't done in over a decade. So that did see a lot of negative flows coming into the markets. And this upcoming week, earnings season obviously continues with another few big names on the schedule, which could have an impact on overall risk sentiment. Then, of course, virus developments. The market saw a lot of positivity earlier this week from the developments made with the drug from Gilead Sciences called remdesivir. Hopes that the drug could be used to successfully treat the coronavirus was pushed into hyperdrive this week, as initial tests showed that a 5-day treatment of the drug showed initial successes in treating the virus. Now, any other significant breakthroughs in treating or preventing the virus, like a vaccine, etc., will be a very important development that we'll need to have a very close look at in the week ahead as well. Then looking at some possible sentiment shifts. Firstly, the dovish shifts. For now, the markets are very focused on any progress being made with the virus. And if we have even more positive developments this week with possible cures or a breakthrough with a vaccine, etc., that can be a real upside risk for risk assets across the board, which would in turn obviously cause some downside for the US dollar. Now, in a recent Bloomberg article, some members of the US intelligence community have said that they do not have any evidence that the coronavirus originated from the Wuhan Institute of Virology in China. Now, that goes against the comments made by President Trump on Thursday. Now, if this news causes President Trump to walk back on his threats of possible tariffs, etc., or other punitive measures against China, that would be a major positive for risk assets and risk sentiment, and should see some potential downside for the US dollar as well. Then turning to Germany, we need to keep a very close eye on the BTP Bund spread this week on Tuesday, as the German Constitutional Court rules whether the ECB's bond buying program is lawful. And if it does pass, and it is deemed as lawful, it would alleviate some of the stress in the Italian debt market and should be a positive input for the euro, and of course a negative input for the dollar in the week ahead. Looking at some possible hawkish sentiment shifts, the dollar's safe haven appeal has been somewhat watered down with the recent policy action by the Federal Reserve, as we've mentioned earlier. However, as we enter into May, the market's attention should now start to turn more towards the economic fallout caused by the nationwide lockdowns. And that makes April's NFP release an important event, as it will provide some insight of the impact the shutdowns have had on the US labor market. Now, in just 6 weeks, we saw over 30 million Americans lost their jobs, according to initial jobless claims numbers. And as consumer spending makes up 70% of US GDP, a very big jump in unemployment means the prospects of a very quick or V-shaped recovery is looking very slim right now, which is why somebody like Fed's Kaplan explained that GDP could contract as much as 30% in the second quarter if unemployment shoots up and reaches close to 20%. Now, a much bigger than expected drop in NFP or bigger than expected jump in the unemployment rate could spark risk of flows this week, which should support the dollar in the short term. Turning to politics, the recent threats by President Trump against China will be very important, as further threats and rising tensions between the two nations will spark further uncertainty and keep risk sentiment cautious. Now, any significant increase in tensions could put further strain on the relationship between the world's two largest economies and would be enough to put pressure on risk sentiment and lead to further support for the US dollar. Then turning back to Germany, another opportunity for the dollar is if the Constitutional Court in Germany rules against the ECB's recent bond buying program, which is aimed at helping struggling countries like Italy and Spain. A ruling against the program should increase the BTP Bund spread, which should see some euro downside and of course be more supportive for the US dollar. Now, the importance of this matter is more important than most realize, and is probably why French President Macron warned in the week that the EU is facing a possible collapse if no joint action is found to help the ravaged economies in the EU. Now, a step in the wrong direction by Germany here could spark bigger divisions and obviously create further short-term pressure for the euro, which should be more supportive for the US dollar in the short term. Then looking at possible currency pairs that we can trade in case of a sentiment shift. In the case of a hawkish sentiment shift for the US dollar, we could pair it against the euro. Now, despite the overall negative economic outlook for the eurozone, the euro remains the biggest net long position among the majors. On Thursday, we saw a massive jump in the euro, which is mainly driven by outflows in the US dollar and inflows into the euro due to month-end rebalancing. And with that out of the way, a hawkish shift in the US dollar will provide an opportunity against the euro. Now, something that could change this is, of course, a positive ruling from the German Constitutional Court this week, which could spark some further upside in the euro. So just keep that in mind. Looking at a possible dovish sentiment shift in the dollar, it's mostly going to be as a result of the overall positive risk flows. And if we do see positive risk flows, we could look to pair the US dollar against the Aussie dollar or the Kiwi dollar if we do have a very positive risk environment at that time. Remember that these recommendations are based on the current fundamental bias for these currencies at the time of writing and can obviously change throughout the week. So make sure to reevaluate whether the short-term sentiment is still valid for these currencies before taking any trades. Then looking at some possible economic news to trade into this week. Now, as the main focus for the dollar this week is on the overall risk sentiment and seeing that the risk sentiment can be fickle and of course change from session to session, we won't be interested in trading into any of the upcoming risk events such as the ISM non-manufacturing or the ADP employment or the NFP. But we could look to any changes in the risk sentiment following these events for possible and the best trading opportunities this week.